Hi, my name is Ben Spiegel. I'm the CEO and founder of Redwood Capital. We are a real estate private equity firm focusing on special situations in the lower middle market. So just to jump right into it, today we're going to be discussing Winter Circle RV Resort. It's located in Mobile, Alabama. After thorough analysis, we are projecting LP net IRRs in the mid-20s, equity multiple above 2.3x, and preferred returns between 8 and 10%, depending on final contribution. So just about the investment snapshot, it's important to note this is an existing 91 pad RV park that has recurring cash flows and a very strong online reputation and loyal customer base. What's very unique about this specific investment is the embedded optionality that it comes with site plan approval for an expansion of 85 pads that's transferable at close. That cuts out almost 18 to 24 months of red tape that normally and costs that normally have to be incurred to get to this point. So within 1 or 2 months post-close, we're able to put a shovel in the ground. This is a true special situation in that we have a clear business plan and a clear path to create incremental value, delivering, as I said before, a 27% IRR and close to a 33% average annualized return for our passive investors. Here's just a quick overview of what we're going to be going over today. We're going to start talking about Redwood Capital and our track record. Then we're going to dive into the RV industry in a little bit more depth. And then finally, we're going to be talking about the subject asset itself, its current performance, the planned expansion, the returns, and then we'll talk about how you can get more involved. This is just some legal matters that this investment is only open to accredited investors. And it is important to note that we are going to be sharing forward-looking analysis. And although we have a strong track record, past performance is never a guarantee of future results. So let's move ahead. So at Redwood Capital, we specialize in uncovering value in niche real estate sectors that are often overlooked by larger institutions. Our contrarian investment strategy focuses on identifying inefficiencies, what I like to call hidden opportunities, in markets that most others might dismiss or undervalue. Over the past 9 years, we've deployed over 85 million across 29 deals, delivering an average annualized return of approximately 25% with 0 investor losses. This is the kind of discipline and consistently we bring to every project that we invest in, including Winter Circle. Most recently, we have shifted our strategic focus to the RV park sector. We view it as a space that's ripe with inefficiencies, delivering strong cash flow, and has strong value add potential in conjunction with being a recession hedge. Our approach is disciplined and data-driven, but really what truly sets us apart is our ability to find opportunity where others don't look. I have built a proven, repeatable business model that stems from our curated investment philosophy. Our contrarian investment strategy is built on 3 core principles. First, the stigma premium, which is my favorite. We always look for assets or industries with a perceived stigma. This allows us to acquire them at a significant discount compared to their underlying cash flows. Second, opportunities we target always have to have quantifiable inefficiencies. That's what I like to call low-hanging fruit. A good example in the RV space would be that 70% do not even accept online reservations. You still have to call the front office. I mean, it is very inefficient and it is not difficult to streamline. Finally, I try to make sure the assets that we acquire have identifiable catalysts where we can quickly add value. These are relatively straightforward in terms of operational bottlenecks, whether it's a bloated expense ratio, where we can fix with a pretty easy restructuring plan. So now let me talk about our backgrounds. As the general partner and CEO, I've overseen the deployment of over 500 million of capital across real estate, distressed debt, and private equity. I started out in investment banking and high yield capital markets. After about a year and a half, I moved over to the buy side, working for a myriad of credit opportunities hedge funds, always really focusing on off the run, off market, out of favor special situations. Bankruptcy and distress. I've analyzed everything from coal mines to tribal casinos to tugboats and dry barges operating up and down the Mississippi and Ohio rivers. And I have truly never seen an asset class that I'm more excited about than this RV park sector. So how I got my start in real estate, though, is I started buying smaller buildings in rundown or workforce areas out just outside of New York City. And after about 5 or 6 years of doing that, I was given the opportunity to buy a much larger portfolio through a non-performing loan purchase. Long story short, I ended up acquiring the note and ended up leaving the buy side to pursue a much more entrepreneurial endeavor when I really knew that real estate was my true calling. Since I acquired that note, I've rapidly expanded, building a portfolio in the Northeast. And then I started moving farther south. And that's when I first started investing in mobile home parks in North Carolina. And that's first when I got invested or got exposed to the RV asset class. I have spent the past 2 years scouring the country for specific micro markets that lack any type of institutional presence that would enable expanding and building economies of scale fairly quickly, which is extremely important in this sector. But that's enough about me. Our director of marketing operations, Kelsey, here brings over a decade of experience in real estate and marketing, personally having raised over 110 million of equity for multifamily syndication developments. She and her team are the gears behind the scene that keep our operations running smoothly. Together, we've built a business model focused on consistency, stability, and investor-first results. We are very proud of our track record that we've accumulated. Over the past 9 years, as I said, we've completed 29 transactions, including 16 full cycle exits. In many cases, we've been able to return invested capital within 24 to 36 months, usually through a strategic monetization event such as a cash out refinance or even a sale, depending on conditions. We pride ourselves on conservative underwriting and a data-driven approach. We always like to underpromise and overdeliver. That's why we have consistently been able to surpass our pro forma projections. We do not do deals just to do deals. We are extremely picky and will only acquire properties that meet minimum return hurdles for our investors, even if it's the bear case. Here are some testimonials from longtime repeat investors who come from sophisticated investment backgrounds. Feel free to request their contact details if you'd like to make contact with them and to speak with them directly. But our internal team won't be the only ones working on Winner Circle. I want to introduce our incredible Southeast operations team who are critical to the success of this goal. Robert Preston, Winner Circle existing property manager, will transition with us in this acquisition. And what's great is he's already transformed the asset over the past 2 years, increasing revenue by 75% while addressing deferred maintenance and securing the approval for the 85 pad expansion that I mentioned earlier. We're also very fortunate to have Roy Anderson III leading our development efforts. As one of the top developers in the Southeast with decades of experience, Roy has managed billions of dollars in transformative projects from hospitality to healthcare. His expertise really ensures that our expansion is executed efficiently and with precision. We also know that in a project like this, it takes more than just internal expertise. We have partnered with industry leaders across legal, management, and financial services to support our operations. I particularly just want to point out Sage Outdoor Advisory, who completed the feasibility analysis on Winner Circle, which you can find in our investor portal for your review. Now let's jump into what makes this industry so compelling. I'll be honest, there is nothing I am more passionate about than diving into an industry where the data shows robust inefficiencies and potential for compounding capital. I can confidently say that no other sector in real estate comes close to the potential of the RV park industry. It's niche, it's fragmented, it's undercapitalized and underserved. In short, The RV park sector is everything we as private equity investors look for when we want to deliver exceptional risk-adjusted returns. Just to give you a few notable data points, right now, there are over 12 million RV owning households in the United States, which represents an increase of 3.2 million or 36% over the past decade. Of those, 1.2 million or 10% are full-time RV residents, which has increased by 500,000 or 67% over the past 10 years. Despite this massive increase in demand, new supply has been muted by large barriers to entry. Right now, there are only approximately 620,000 RV pads in the United States, which represents only about a 26% increase since 2014. On average, only about 10,000 new pads are added every year on a net basis. To give you some perspective, that means for every 100 RVs shipped in the past decade, only one pad was added. Currently, and this is the very important item to note, 85% of RV parks are owned by mom and pop single operators. They often lack resources or the wherewithal to scale, modernize, or optimize their operations. As a result, the park market is full of inefficiencies and represents ripe opportunities for mispriced off-market acquisitions. We talked about the growth in the sector, and here are some of the more compelling visuals, but I want to highlight how strong this industry performs in case of an economic downturn. This is very important, the recession resilience aspect. It is a cost-effective option as well as an affordable housing alternative. Even though it's stigmatized, it represents a thriving community that people love to stay and are loyal to, no matter the economic climate. It's truly hard to believe unless you've set foot down there yourself in the Southeast and you get to truly experience these parks in person. Here's some more data on the supply-demand imbalance, including domestic RV shipments and occupancy rates. Feel free to take a closer look at your leisure. We are of the firm belief that this is not a cyclical change, but a structural shift in American culture. They want greater flexibility, adventure, and affordability. This table is another data visual of the supply-demand imbalance. I do want to highlight all the way to the right the full-time demand ratio between full-time RV livers and the amount of pads available. It's just unbelievable how strong the supply-demand imbalance is compounding and how fast it's growing. What many think of as an RV park falls under campgrounds, parks, and more recently resorts. However, in the last 5 to 15 years, the two most popular types of destinations are communities and resorts. Resorts they have to be at a premier location, whether it's next to near Disney World or on the beach. They have a much higher average daily rate. These usually have much shorter stays with unique value propositions, but they're also heavily impacted by seasonality and may even close entirely during the winter months. Our strategy at Redwood is to target community and hybrid parks because they offer stable income with the lowest vacancy rates. Just to give you an example, resort vacancy rate could be as high as 70%, whereas a community like Winter's Circle has only a 12-month trailing vacancy of 10%. Last year, we had a 90% weighted average occupancy rate. These types of parks cater towards much longer-term residents who stay anywhere from a couple months to longer than a year. Another benefit of the community model is revenue diversification. Some of the simple ways that we're going to be augmenting revenue is through utility billbacks, storage, laundry, electric on-site convenience stores. Our residents are often transient workers that actually make well above the average income. They choose RV parks because they want to be able to bring their home with them when they change jobs instead of dealing with finding an expensive short-term rental. There's also a significant amount of retired or semi-retired RVers, usually snowbirds from the Midwest. And let me tell you why that's important. Roughly 10,000 baby boomers will turn 65 every day through 2030. As you can see, retirees already account for over half of RV owners, and that proportion is expected to further increase to 55% over the next 5 years. This slide shows the target market analysis. We don't have the time to dive through, but I'd be more than happy to talk about it in a private session. One thing I'd like to highlight, though, is the demand-supply ratio for this specific market is 54.3 versus 42.5 on the national level. So throughout my career as a generalist analyst, bottoms-up cash flow analyst, I've analyzed every industry from coal mines to casinos to inland maritime, and I have never seen such compelling data to support an investment thesis. I have spent the past 18 months scouring the country for certain micro markets that completely lack any type of institutional presence and, like I said, are ripe for consolidation. I truly believe that Mississippi and Alabama and the Panhandle of Florida represent the last frontier of this market. I have never experienced a more pro-business environment where the cost of living is low and the favorable climate makes it an ideal place to stay. Alabama might seem out of the way, but it's within a 500-mile radius of over 65% of the US population, which makes it within a very manageable drive for an RV. For decades, parks have largely been owned by independent mom and pop operators. These owners often have a strong emotional attachment to their business, which leads them to clouds their judgment regarding making the best strategic decisions. I have seen time and time again these owners lacking the resources, motivation, or wherewithal to invest back into the business to upgrade their parks to the level today's RV owner not only considers an amenity, but a necessity. A prime example of this would be strong Wi-Fi and online reservations. For institutional investors like Redwood Capital, this represents the perfect storm for a simple pure play value add opportunity. Here we put together a SWOT analysis for you to go review on your own. Because what I really want to talk about is the financial profitability of RV parks. When we look at different asset classes within real estate, profit margins are usually the most important single KPI. As you can see on the bottom left, RV parks on average command a 43% profit margin versus just 30% for residential and 25% for commercial. What I want to emphasize this profitability is with 85% of the industry being owned by mom and pop operators, meaning that there is incremental room for further margin enhancement. Imagine how we can increase our profit margins with sophisticated management systems. We aren't the first to notice the tremendous value add that RV park asset class represents. Several private equity firms and REITs have already begun targeting this sector. It is important to note, though, that they are not looking to acquire properties unless they're 300 pads minimum or about 10 to 15 million purchase price. This is the prime reason why we love the lower middle market, as we are able to acquire off-market direct from mom and pop sellers and then sell at a premium to institutional buyers. It isn't rocket science, and it's very straightforward. We are specifically targeting this industry because it's still in its infancy in terms of institutionalization. Now let's dive into the investment itself. The property at acquisition has 88 existing full hookup pads and 3 permanent structures. As you can see on the right, it already has a strong digital presence with an attractive website and strong Google reviews, not meaning we're not going to make it better post-close. The park operates on a community business model, meaning that it serves longer-term residents. This consists of retirees, full-time RVers, and the transient workforce I mentioned earlier. That's why there's an 88% trailing occupancy rate. It proves that there is a strong existing demand, which is expected to grow over the coming years. Because the park operates as a community model, it is so important for it to be in close proximity to the staples such as supermarkets or a Walmart, but it's also 5 minutes away from a new 800,000 square foot distribution center of Amazon that Amazon just built, and 15 minutes from the Port of Mobile, which is the second largest, fastest growing port in the United States. We chose Winter Circle not only because of its prime location, but because it represents a unique special situation acquisition. The property is being sold to us off-market by a forced seller at a discount to recent comparable transactions. It has existing stabilized cash flow and approved site plans to build an additional 85 pads. These site plans took the seller nearly 2 years to obtain, so it dramatically shortens the investment time frame, meaning we will be shovel-ready by February. The reason we like Mobile is that it is not on the top of everyone's list to visit. We pride ourselves on being the first movers and discovering secondary and tertiary markets before they become saturated. Just to rattle some fun facts, Mobile County's GDP last year was over $29 billion, which represents a $7 billion increase or 31% since 2020. Just to put that in perspective, New York only experienced 22% growth over the same period. Mobile's deepwater port has grown by double digits every year for the past decade. On top of that, there's over $1 billion of planned investment in the next decade to expand further. Like I said earlier, Mobile is extremely business friendly, offering incentives and tax exemptions with very low property taxes. Pinpointing into Theodore, home prices grew over 9% last year despite record high interest rates. As we have repeatedly stated how baby boomers represent a critical customer base, 25% of Mobile's population is over the age of 55 and is expected to increase 10% over the next decade. Last week, we loved to see a 15% increase in RV registrations in Mobile County alone over the past 3 years. We like Theodore because it's warm, has a large transient workforce, and is in an area experiencing tremendous economic growth. RV life has evolved far beyond tourism. As I said, this is a structural shift. It's now a valid long-term housing solution alternative for a wide range of people. While Mobile is one of the more affordable housing markets in the United States, the median household income is still only about $30,000, but more than $25,000 below the national level. So what this means is people can't afford to rent an apartment or buy a home, and that's where RV parks can fill an interesting gap. The monthly total cost of RV ownership and monthly park rent still represents a significant discount to traditional housing options, and they offer flexibility. Residents can stay for a month or a year while having access to amenities like a heated pool, on-site laundry, and very pet-friendly environment. You can say RVers enjoy the feeling of home ownership without land ownership. So Winter Circle currently has the lowest rental rates when compared to similar comparable parks. It's over a 35% discount to the comparable average. It just shows how much room there is for us to increase rental rates on the existing sites alone. You should keep this data close when you review our underwriting because it proves just how extremely conservative we are. Our projections have the average rental rates at less than $800 in month 24 of the investment after significant capital investment. This slide shows the close proximity of other comparable parks that were on the previous slide. On the bottom left, I just want to highlight you to show what's so striking is that there's little to no seasonality. So what was Winter Circle 2.5 years ago when the seller purchased it? After acquiring it from a mom and pop seller, there's always a significant amount of deferred maintenance and bothersome legacy tenants. The 24 months post-close from a mom and pop seller are the worst. He has taken care of the vast majority of the heavy lifting, cured all deferred maintenance, turned over all the troublesome tenants, and he grew monthly income by close to 75%. He's also, in conjunction with putting in a new marketing strategy, like I said, that include new website, SEO optimization, and online reservations. Today, Winter Circle boasts modern amenities, a loyal base of recurring tenants, and approved development plans that are ready for execution. This is the kind of value-add foundation. This kind of value-add foundation significantly mitigates typical risks that are associated with this type of acquisition. The property is now perfectly positioned for growth. Which brings us to our business plan. As I mentioned, we are buying Winter Circle with the site plan in place. Getting site plan approval is the longest and most costly aspects. What is so interesting and unique about this acquisition is we already have strong cash flow in place that will help carry us through the incremental investment and expansion. Just to touch on why RV park construction is so different from a normal building construction is that it's all horizontal. There's almost no vertical, which means we're just dredging, we're laying electric, plumbing, and then we're pouring concrete, and we're done. The total construction budget, including CapEx budget to improve the existing pads, is just around $3 million. This is a very straightforward business plan that is projected to deliver strong risk-adjusted returns. We really do pride ourselves on under-promising and over-delivering. At the time of sale, we are projecting an exit cap rate of around 7%, which is higher than what much smaller parks are transacting at even today. With a projected NOI of just over $1 million, that gives us an exit valuation of around $14.5 million. For investors, after all expenses and fees, we projected to deliver a net internal rate of return of 27%, or approximately 32.5% average annualized return. The expansion will take place over 9 months, and to be fully transparent with you, half of that time is due to waiting for a new electrical transformer to be delivered by Alabama Power and installed by the county, as there's just a shortage in the area after what's happened in North Carolina recently. The good thing is we already have this information and it allows us to put this together in a realistic timeline. We already have a new marketing blitz prepared with 3D renderings and a video to help fill the park as quickly as possible post-construction. On the screen now, you see Winter Circle existing site plan on the left and the expansion site plan filling the screen on the right. Construction will begin immediately post-acquisition with all 85 new pads completed within 12 months. The park is expected to stabilize and refinance by year 3 with full exit planned by year 4. Here is a quick summary of the property and the investment structure. The purchase price for Winter Circle is $4.25 million, with an additional $3 million or so for expansion costs. That brings the total equity raised to $3.52 million, and at close, the total debt financing to about $4.83, resulting in a combined loan to cost of about 75%. The capital structure is designed to maximize investor returns while maintaining manageable leverage, ensuring both stability and strong cash flow throughout the whole period. With this setup, investors benefit from significant upside through refinancing and an eventual property sale. Now to look at the financial projections. The stabilized NOI is projected at around $1 million, supporting an exit valuation of over $14 million based on the conservative 7% cap rate. Our capital stack and conservative underwriting ensure strong cash flow during operations, with refinancing in year 3 expecting to return close to 60% of initial capital. So for every $100 in, you get 60 back. Our approach balances upside potential with risk mitigation, offering attractive risk-adjusted returns for our investors. This slide shows a much more detailed breakdown of the expansion budget, highlighting both hard and soft costs, as well as the CapEx for the existing site improvements. Please feel free to look at the expert budget feasibility analysis in the data room, and of course, we welcome any questions. We've already talked about the returns, but I want to highlight them again. For every 100,000 invested, you should expect to receive 230 or a 2.3x equity multiple. These are very strong returns, especially in a high interest rate environment. Lastly, I want to touch again on our strategy, our exit strategy. Our target buyers include institutional investors and REITs looking for stabilized, high-performing RV assets. The planned improvements in NOI growth ensure a competitive position for a profitable exit. So after all that, let's talk about how you can become an investor. This is a 506c offering for accredited investors only, with a minimum investment of $50,000. To mitigate investor risk and ensure our interest is aligned with yours, we have tiered investment classes based on investment amount. Essentially, the higher you invest, the greater your preferred return is. We ensure investors' first returns. We, as the sponsor, are always first in and last out, meaning that it's an investor-favored waterfall structure that we will only receive our initial capital back once our investors have received their initial investment and their preferred return. Thank you for your time. Further details will be posted. Now we'll hold the Q&A session.